This is a weekly podcast of our average Indian investor. Welcome to another deep dive. Today, we're getting into something really fundamental, mutual funds.
That's right.
Specifically, the difference between equity and debt funds.
Yeah.
We want to make it super clear, which one might suit you better depending on your goals, your comfort with risk.
Exactly. And without all the confusing jargon.
Yes, none of that. We want this to be straightforward. So people hear mutual funds, but this equity versus debt thing is key, isn't it?
It absolutely is. It's kind of the first big fork in the road. Knowing this helps you understand where your money's actually going and maybe more importantly, what kind of journey to expect, the potential highs and lows.
Okay, let's start with equity then. Equity mutual funds. If someone's completely new, what are we talking about?
Okay, think of it like this. Buying a share means owning a tiny piece of a company. Equity funds just pool money from lots of people.
Like you and me.
Yeah, exactly. And they use that big pool of money to buy shares in many, many different companies. And legally, to be called an equity fund, most of its money, usually over 65%, has to be in these shares.
Right. So the main goal is growth, like hoping the value of those company shares goes up over time.
Precisely. The primary objective is long-term capital appreciation. That's just a fancy way of saying growing your money over the long haul. You're basically betting on the future success of those companies.
Makes sense. Now, you hear terms like large cap, mid cap, small cap. What's that about?
Yeah. That mainly tells you about the size of the companies the fund is buying shares in. Large cap means the big established players, the famous names.
Household names. Yeah.
Exactly. Mid-cap funds go for medium-sized companies, maybe less known, but with good growth potential. And small-cap funds, they invest in even smaller, sometimes newer companies.
Okay. And I guess there's a difference in risk and potential return there.
For sure. Generally, the smaller the company, the higher the potential for, really fast growth. And it's a big, but also higher risk. Small companies can be more volatile, more affected by economic shifts.
Right. And sector funds, like tech or pharma.
Yeah, those funds concentrate just on one specific industry. So if you invest in a tech fund, it only buys shares of tech companies. High potential if that sector booms.
But risky if that whole sector hits a rough patch.
Exactly. You're putting all your eggs in one industry basket, basically.
Got it. Okay, so that's equity owning pieces of companies, aiming for growth, different risk levels depending on company size or sector. Let's flip to the other side. Debt mutual funds. How are they different?
Well, instead of buying ownership, debt funds essentially lend money. They invest mainly in things called fixed income securities.
Lending money. Like, to who?
It could be the government, big corporations. The fund buys things like government bonds, corporate bonds, treasury bills. Think of them as IOUs. The borrower promises to pay back the loan amount after a certain time, and along the way, they usually pay regular interest. It's generally a more predictable source of return compared to stocks.
So the goal here isn't so much about the value shooting up, but more about getting that steady interest income and keeping the original investment safer.
That's a really good summary. Debt funds focus on providing regular income and critically preserving the capital you invested. Stability is a key word here.
And like equity, are there different types of debt funds too?
Oh, absolutely. They're often classified by the duration, like how long the loans are for. You have liquid funds.
Yeah.
These invest in super short-term things, maybe just days or a few months.
Okay, like for emergency money you might need quickly.
Exactly. They're very low risk, very easy to access. Almost like a savings account, but often with slightly better returns. Perfect for an emergency fund.
Makes sense.
Then you get short-term funds, medium-term, long-term funds. As the name suggests, they invest in loans with longer payback periods.
And does longer mean higher return potential?
Generally, yes. Longer-term bonds might offer higher interest. But there's a catch. They can also be more sensitive to changes in overall interest rates in the economy.
How so?
Well, imagine interest rates go up significantly after you bought a bond paying lower interest. That older, lower-paying bond becomes a bit less attractive compared to new bonds being issued at higher rates. So its market value might dip a little.
Okay. So even debt funds have some nuances with risk.
They do. It's generally lower than equity, but things like interest rate changes and the creditworthiness of the borrower, are they likely to pay back? These matter.
Right. Okay. So we have equity for growth potential via ownership
Yeah.
and debt for stability and income via lending. Let's crystallize the key differences for someone trying to choose.
Okay, let's break it down. 1, what they invest in. Equity, stocks, ownership. Debt, bonds, T-bills, loans. Simple enough.
Got it.
2, risk. This is a big one. Equity funds you to risk. The stock market jumps around a lot. That's volatility. Debt funds are generally lower to moderate risk.
Because lending feels inherently safer than the stock market's roller coaster.
Pretty much, yeah. Especially lending to stable governments or big companies. 3. Returns. Equity. Potential for higher returns, especially long-term, but they can fluctuate wildly. Debt, typically lower, but more stable, more predictable returns.
Okay, risk and return are linked. What else?
4. Time frame. How long are you investing for? Equity is usually better suited for longer-term goals. Think 5 years, 10 years, or more.
Gives time for the market ups and downs to hopefully average out upwards.
Precisely. Debt funds, though, they can work for short, medium, or even long-term goals, but they're often preferred for shorter periods where you really need that stability.
Right, and taxes. That always comes up. How are the profits taxed differently?
Yes, very important. For equity funds, it depends how long you hold them. Sell within a year. That profit is a short-term gain, taxed at 15%. Hold for longer than a year. It becomes a long-term gain. The first year or 1 lakh of gain in a financial year is tax-free, and anything above that is taxed at 10%. Correction. The long-term capital gains tax is 10% on gains above 1 lakh, and short-term is 15%. Correction. The new tax regime has some changes. Let me double-check the latest rates for equity and debt. According to the latest information I have, for equity funds held over 12 months long-term, gains above 1 lakh are taxed at 10%. Short-term gains, held less than 12 months, are taxed at 15%.
Okay, so long-term holding is favored tax-wise for equity. What about debt?
Debt funds changed recently. Now, regardless of how long you hold them, any profit you make is simply added to your total income for the year and taxed at whatever your income tax slab rate is.
So no special long-term benefit like with equity anymore.
Correct. That's a significant change. Makes debt funds potentially less tax efficient for those in higher tax brackets, especially for longer holding periods compared to equity.
Interesting. So boiling it down, who fits where?
Generally speaking, if you're okay with taking on more risk for the chance of higher growth and you're investing for the long term, equity funds might be a good fit.
And if you're more cautious?
If you have a lower risk appetite, prioritize keeping your money safe, maybe need a steadier income stream or have shorter term goals, then debt funds are likely more suitable.
Let's talk about short-term goals specifically. Say, saving for a down payment in a year. Why is equity usually not recommended?
Well, like we said, market volatility. Imagine you need the money in 12 months, but the market takes a big dip right when you need to sell. You could actually lose money.
Not ideal.
Not at all. Plus, some equity funds have exit loads fees if you sell too early, say within the first year. That just eats into your money further.
So the risk of losing value quickly and potential fees make it a bad bet for short-term needs. Why are debt funds better there?
Debt funds, especially the shorter duration ones like liquid funds or ultra short-term funds, are just much more stable. The risk of losing your initial investment is significantly lower. And while the returns might not be spectacular, they're often better than just letting cash sit in a savings account. Plus, you can usually get your money out fairly quickly without hefty penalties. It's about safety and accessibility for those near-term goals.
That makes a lot of sense. Okay, so before anyone jumps in, any final checklist of things to really consider?
Absolutely. First, be brutally honest about your risk tolerance. How much sleep would you lose if your investment dropped 10%?
Good question.
Second, your goals. What's the money for? When do you need it? Is it retirement in 30 years or a vacation next year? That changes everything.
Crucial.
Third, if looking at equity, remember, past performance isn't a crystal ball. Look at the fund manager's experience, the fund's long-term track record, but know it's not guaranteed.
Right.
And for debt, be aware of interest rate risk, especially for longer-term funds, and check the credit quality. You want funds lending to reliable borrowers.
Makes sense. Anything else?
Diversification. Don't put everything in one fund or even one type of fund. Spreading your money around usually helps manage risk. Maybe a mix of equity and debt could work for many people.
Right, finding that balance. So really the big takeaway is that this choice isn't about which is better overall, but which is better for you.
Exactly. It boils down to your personal financial picture, your specific goals, their timeline, and critically, your comfort level with risk.
So shorter term, lower risk tolerance, maybe lean towards debt. Longer term, okay with market swings for potentially higher growth, perhaps equity fits better.
That's a good rule of thumb to start with.
Okay, great discussion. You can catch further episodes of Your Average Indian Investor on YouTube or Spotify. Please like, share, and subscribe if you like our content.
Definitely.
And maybe a final thought for everyone listening. Really take a moment to think about your own situation, your goals, your risk appetite. Understanding yourself is the first step to making smart investment choices. And, if you're unsure, exploring more resources or even chatting with a qualified financial advisor could be really helpful.
Sound advice. It's your money after all. Make informed decisions.